everyone, I'm Alex. Welcome back to this particular episode of Behind the Stock Unscripted. Now for the past 1 week, the stock market corrected, especially the tech stocks. So what happened? Today, let me share with you why. Firstly, it's due to the US inflation rising higher and staying longer than expected. Now, quick explanation of the situation. The Federal Reserve System is a central bank of the US. Now, let's think of it like a Malaysia Bank, Negara, or Singapore MAS. In order to stimulate the economy, the US need to pump in more money. But the government cannot just anyhow print money. So what the US government did was to create bonds for the Federal Reserve to buy. And in order to buy the bonds, the Feds then print more money. When this happened, the government debt keeps piling up. The issue now is, although the economy starts to recover, but the inflation is getting higher and is lasting longer than expected. So what they are doing now is creating lesser bond and printing less money, a process called tapering. Central bank officials indicated that they are ready to begin tapering. They will be slowly pulling back the stimulus they are providing during the pandemic. While the Fed has gone into policy retreat before, this is the biggest pullback. For most of the past year and a half, it has been buying at least 120 billion US dollar bonds at each month, providing strong support to the financial market. The purchases have helped keep interest rate lows. Now, the Fed's Chairman Powell says the official tapering decision could happen at November and finish sometime around middle of next year. What happens after the tapering is what's really important. Officials see as many as 3 more interest rate hikes in 2023 to 2024, bringing the Fed's benchmark borrowing rate to a range of 1.75 to 2% from its current 0 to 0.25%. Rising inflation also caused the investors to sell down US Treasury bonds, causing the bond yield increase even before the Federal Reserve confirmed it will likely soon begin reducing its bonds purchases, which could lower bond prices and lift their yields. The 10-year Treasury yield increased to 1.49% from 1.31% in September. Now, I won't go into details the Treasury yield, but just need to understand that when the yield goes up, the interest rate will go up as well. The cost of borrowing also becomes more expensive, which eats into the profitability of the business. Technology stocks were particularly hard hit as bond yields rose. Higher bonds yields makes future profits less valuable. All this then leads to another issue, which is the second reason why the stock market is in fear. The US now has too much debt, and they are getting new debts to paying old debts. But there's a limit to how much debt they can take on, which is called the debt ceiling. Now, debt ceiling is the legislative limit on the amount of the national debt that can be incurred by the US Treasury. If the government cannot lift or suspend their debt ceiling, the US Treasury won't be able to repay their outstanding debt payments. The first target comes October 18, the estimated date when the US will no longer be able to pay its bills unless Congress raises or suspends the debt ceiling, according to Treasury Secretary Janet Yellen. If Congress fails to address the debt ceiling, it will raise the cost of borrowing and increase the threat of a first ever US default. That worst case scenario could cost the country jobs and damage the global economy. Failure to raise the debt ceiling would not only shut the door on future spending, but also prevent US from paying for its current obligations. On the 7th of October, the Senate approved a bill to help US avoid defaulting their debts in the next few weeks. The agreement allows the debt limit to increase by $480 billion. The current national debt is about $28.4 trillion, and with this agreement, they can raise the debt ceiling to around $28.8 trillion. The Treasury Department estimates that this amount will give the US more time and breathing room, at least until 3rd of December. But the risk of defaulting still remains. As an investor, we are not able to control or predict the market. We just have to stay cautious. Always stay invested, but never all in, so that if there's opportunities, we can grab it at a lower price. Then, wait patiently for the market to rebound and recover, because time and time again, the market has proven to all that it will continue to grow over long term despite various corrections. Now, if you learned something in my video, please like the video, share with your friends and family so that they can also learn something as well. And of course, stay safe, stay healthy, invest cautiously. Till then, I will see you. Bye guys. Bye-bye.